Hey guys, so the Federal Reserve might just print more money to help stop us from going into an economic recession like this. So just imagine they have these 4 giant printers and they're about to print a lot more money. Kind of like this. 3, 4. Wouldn't it be so easy? Hey, do you guys have a dollar I can borrow, maybe?
No one ever sees me, I'm losing every battle. No one ever sees me.
Hey frugal people, happy Monday morning, and I hope you had a wonderful weekend. My name is Andrei Jikh, and today is the beginning of the end for the stock market. Or so the media tells us for a while now, but I wanted to make a video that talks about the best companies to own throughout a recession. So in today's video, I'm gonna share with you companies that have paid their investors for 50 straight years. That's right, 50. They have increased their dividend payments throughout the craziest of historical times. And that is, they have lived through economic recessions, technological advancements, and boy, it's getting bright on my face, isn't it? Let's stop down here. Yeah, that looks good. They've also lived through the invention of the internet, social media, Snooki, and Octomom. Like, you name it, they have seen all of it. But before we get started, a quick word of caution. Because last week, stocks have posted their worst performance of 2019. And that's because Donald Trump tweeted, he just tweeted, "Thanks a lot, Donald. Thanks for everything." What he basically said was that he was going to impose a 10% tariff tax on $300 billion worth of Chinese imported goods. And that's bad news because China responded in kind and was like, well, if you're going to tax us, we're going to tax you back, which makes sense. But for investors, that is bad news because historically speaking, tariffs have not been good for economic growth policies. And so because of that, presumptuously, indubitably, the Federal Reserve might want to step in and stop us from going into an economic recession by printing more money, which is never good. It's the same reason that $1 could buy you so much more in the past, right? Like for example, in the year 1919, which is 100 years ago, $1 was actually the same as $14.81. Almost $15 of purchasing power just for $1 100 years ago. That's crazy. So I found this website, which I'll leave a link in the description below, where you guys can plug in the numbers and see for yourself for each year just how much a dollar was worth as compared to today. It's kind of crazy to think about.
Hello, Papa John's.
Hello, Papa John's? Hey, I'd like to order a large pizza for $1, please. I think they just hung up. I'm telling you, $1 ain't what it used to be. So, what do we do then, Andrei? Do we just keep our money in the bank? Do we buy Bitcoin? Sorry, something stuck in my eye again. I don't know what that was. Or what do we do? Well, first we smash the like button because Andrei's life depends on it, as we know. And secondly, we're going to invest and diversify our money into high quality paying companies because think about this. We give our money to these companies. These companies then charge more for products and services because of inflation, which means when people buy their goods and services, they make more money. And because those companies make more money, we as investors make more money on our money, which means we get to escape inflation. Pretty smart, because if A equals B and B equals C, that must mean A equals... So here we go. Here are the top 7 stocks to own. Now, if anyone says,
This video starts at 4 minutes.
I am deleting you from the internet, you know who you are. So I'm gonna slow down right now because I wanna make sure everything I say makes sense to you guys, and I'm gonna throw a lot of numbers at you. And I know I lose people pretty quick when I start to get too into the weeds with it. So I hope everything makes sense, and if it doesn't, please let me know in the comments below. I usually respond to everyone that I can. So at number 1 is 3M. So I have my little notes right here. 3M is from the industrials sector, and it has a dividend yield of 3.38%. So I typically try to aim for companies that yield between 3 to 4%. So for example, for every $100 that I invest in this company, for example, in the case of about 3%, that means I would get paid $3 a year just for holding it, right? That's how that works. And it'll pay me that $3 for every 100 throughout the course of the year. So having said that, right now it is 31% above its 5-year average. So over the last 5 years, it has typically paid less, but right now it is yielding above 31% higher than normal, which could suggest that the company is undervalued, okay? Now, having said that, the safety score of 3M for its dividend is 75 out of 100 according to Simply Safe Dividends. So here's the breakdown. Anything between 60 to 100 is considered safe, which means that usually, even during a recession, something between 60 and 100 will still remain, and that company will still pay you dividends. Because the way dividends works, guys, is that a company does not owe you dividends. It is not in any contract or obligation to pay you, but a company will go towards incredible lengths to never cut and stop paying its dividend. It's kind of like a promise to investors that we will pay you for supporting and holding our shares in our company. And that's how it works. But you're not owed that, and at any moment they can cut the dividend. But the best of companies, like the ones I'm mentioning in this video, have never cut, and in fact they have raised the payout every single year for the last 50 years, okay? So that's something to keep in mind. Now, scores that are between, say, 30 and 60 are not necessarily companies that are bad or will cut their dividend. It just means that during a recession, they're more susceptible to cutting it or stopping it, if that makes sense. Now, full disclosure, I don't own 3M at the moment, but I want to buy it really, really soon. So having said that, right now the dividend yield sits at 3.3%, which is a level that has not been seen since 1995 during the economic crisis. Now, number 2 is GPC, which is Genuine Parts Company. They're a consumer discretionary sector with a dividend yield of 3.31%, which is again super in line with what I want, between 3 and 4%. If a stock is yielding 3 to 4%, I'm happy with a slow growth rate of like 5 or 6% per year, or 5 to 10%, let's say. But anything that's above anything that's like 2% or something like that, 2.5%, I would expect something like mid-teens, like 15 or 20% growth is probably what you want. So in this case, it's 3.31%, and it is right now 17% above its 5-year average, which means over the last 5 years, it has typically paid 17% less. So right now it's higher, which again could be an indicator that it is undervalued, and that is GPC with a score of 72. Again, super solid. And then coming in at number 3 is Hormel Foods, or HRL, which is from the consumer staples sector. Now, right now it is yielding 2.03%, and it is 8% above its 5-year average, which could suggest that it is slightly undervalued. And having said that, it has a dividend safety score of 99, which is very, very safe. So having said that, I told you guys I aim for a dividend yield of between 3 to 4%, right? Well, in this case, Hormel Foods is 2%, and I own Hormel Foods, so why would I buy it if it doesn't pay me what I want? So for every $100 I invest into Hormel Foods, it would only pay me just $2 for a year. So that's very little. So what's the trade-off? The trade-off is that its dividend growth rate, the rate that it's growing its dividend, is really high. Or at least for something like 2%, you should want to aim for a growth rate of 15 to 20%. So like a solid mid double-digit teens percent. So anything between like 15 to 20% is super solid. So for Hormel Foods, that's kind of what they've been doing. Right now, they have been growing 12% in the past year, which is good. And they've just been increasing their dividend for so long. And again, a dividend safety score of 99. So at number 4 is one of my favorites, and that is Johnson & Johnson from the healthcare sector. And I own like $10,000 worth of stocks with Johnson & Johnson, and they've just been one of the best companies. And right now, it's not particularly overvalued nor undervalued. It is fair valued. And again, for solid companies, it's okay to buy them when they're fairly valued. Their dividend yield is 2.90%, which is almost 3%. Also with a score of 99. Very, very safe. And in the last 5 years, they have grown at 6% per year on average, which is great for a 3% dividend yield. And in the last 20 years, they have grown at a 10% dividend growth rate. Coming in at number 5 is EMR, or Emerson Electric Company. Now, they are from the industrials sector, and it also looks reasonably valued. Again, not cheap, not expensive, with a 3.18% dividend yield and a dividend safety score of 78, which is good. Now, this year, they've only grown by 1%, which is very slow. In the last 5 years, 3%, also pretty slow. But in the last 20 years, it averages out to about 6%, which is in line with what we look for. Number 6, since I don't have 6 fingers on this hand because I'm just doing my thing, right? I have Lowe. So Lowe company from Consumer Discretionary, and that is 27% above its historical 5-year average, and it yields 2.22% dividend yield. So again, for every $100, think about it like I'm gonna get $2.22. And yes, it's low, pun intended. Get it? It's a low dividend yield. But having said that, it's growing very fast at 17% per year. And again, that's solid. Like I said, anything that's 2%, 2.5%, something that is 17% growth rate is amazing. And it has a 93 safety score. Super great. And coming in at number 7 with the knockout is Coca-Cola. Who doesn't love some KO? It's Warren Buffett's pretty much favorite company to own, and it's one of my favorites as well. It's a great company, and who doesn't love some Coca-Cola, right? So it has a dividend yield that is 6% below its 5-year average, which could suggest that it might be slightly overpriced, but not by much. I don't think it would be a particularly bad time to invest in it. But having said that, this year it has grown 3%, pretty slow, and in the last 5 years, 6%, and in the last 20 years, 8% growth rate, and their dividend yield right now is 3.06%. So a solid $3 out of every $100 that you invest. And it has a dividend safety score of 80, which is great. So once you buy any of these stocks, I want you to watch my spreadsheet video where I disclose and show you guys exactly what to do, how to track this stuff, how to input it, how to numbers it basically. It's a very fun video. And if you're not subscribed, which apparently 85% of you watching this stuff are not, what are you doing with your life? Go subscribe and I promise all of your problems will go away. That's a lie. Guys, the Magic Convention is in town, so all of my friends are in town. I'm going to be doing a lot of collaborations. I know some very successful people in the entertainment world. I'd like to interview them about money, what they do with investing. I think it's all a very fun subject, so you may see a little bit of a few card tricks here on my channel coming soon. So love you guys and see you very soon. Peace out.